Hello, I'd like to start 2021 with a quick look back at last year, try and understand what happened, why that happened, and what this all means for the years ahead. Now, as everybody knows, 2020 was quite an unexpected year. We were hit with a major global health crisis, and that led to what frankly is an economic crisis. Now, surprisingly, every single group of clients that we have by risk, they all made a positive return during the year, which is not what most people would expect. Now, the major reasons for that are firstly, after the crisis, investors tended to dash for safety and run for government bonds, and they rose in value during the year. And secondly, after the crisis, governments and central banks threw money at markets and people to try and support people through the crisis. And that money, through one way or another, found its way into the stock markets. The stock market investments tended to do quite well. Now, on average, most investors made single-digit returns, but against what you would expect, I think that is far ahead of people's expectations. Now, the two key things that determined how well you did last year were you protecting the downside risk by holding lots of government bonds, and I can very happy to say that we were, and we did that for a clear reason, and we had anticipated some economic problems, not COVID, but economic problems, and we were rewarded very well for that, and our investors did well. The second aspect was how much exposure did you have to US technology companies? Now there, we had less than some of our competitors. So what it meant was as the stock market recovered, the US technology sector really led that in a very dramatic way. And if you had a high level of exposure to that, you would have rebounded faster than we did. So for the first time in our 6-year performance track record, we had one of our risk buckets, the high risk bucket, where we actually underperformed the average fund in that sector by a few percent. That's the first time that's happened. Now, what does this all mean for the next few years? I think if you look at what happened last year and the returns that were generated, I would think of them as kind of low quality returns. And by that, I mean they weren't driven by underlying fundamentals. They were driven by fear of loss in terms of government bonds and massive liquidity injections, which led to an increase in valuations. Now, what this means as an investor in both cases, in the government bond market, yields have declined as the price has gone up. So the return that you get from here is now lower, you might get. And in the stock market, valuations have gone up. So the increase in price hasn't been driven by improved profitability. Now, in both of these instances, in effect, what you've done is you've stolen returns that you might expect to make in a few years' time, and you brought them forward to this year. So as investors, we have to be very responsive to that. And our view, we have to be quite nimble. So those of you who've been following us for a while know that we expect inflation, and we think that's where the pain is going to come. But actually, just generally, we think you need to be much more active now than you have needed to in the past. So we think it means a much higher weight towards value companies in the UK market and being quite careful about being too exposed to government bonds. So that's what we're doing, and that's how we expect to make you money in the next few years. Thank you very much for listening. As always, I need to remind you that we are an investments orientated company, and when you're talking about investments, you must be aware that your capital is at risk. Thank you.